Well, thanks. As the slide indicates, I'm Ed Combs, president of the El Camino chapter of CPCU, and it's my privilege to welcome John Sauerland to our meeting today. Although John was born, raised, and now resides in Northeast Ohio, he does have a California connection. John joined Progressive in 1990, fresh from a successful college years at UCLA, where he studied applied math and spent 4 years as an All-American swimmer and member of the U.S. national swimming team. He received his MBA from the University of Chicago. In his career, he's enjoyed considerable success. He's Progressive's current chief financial officer, and prior to that, its personal lines group president, by far Progressive's largest business unit. He's an active member of the Northeast Ohio community as a trustee of the Cleveland Museum of Art, the food bank, and numerous other positions. John, we're very pleased to have you join us today and share your perspective on auto insurance. John?
Thanks, Ed. Great to see you, at least virtually. Thank you all for having me. I do have some perspectives to share on the auto insurance industry and its future. And I'm happy to take questions when we're done. So I will just jump in and hopefully successfully share my slides. Is that looking good, Ed? You're on mute.
Your title slide looks terrific. I caught a whiff of the second slide, and I'm maybe less pleased with that one, but go ahead.
All right. Well, I am going to share some perspectives, but the slide Ed is referring to is this one. So in preparing for this, I reached out to some of my Progressive colleagues and said, hey, I'd like some pictures of Ed over the years. And not surprisingly, I had more than one person respond. So Ed and I worked together many, many years ago at Progressive. I was a rookie product manager, and Ed ran what we called corporate marketing back then. And I guess most companies would call that centralized product development or product R&D, we call it today, actually at Progressive. And back in those days, Progressive was a lot smaller than it is today. And we let product managers do pretty much whatever they wanted, which at times yielded great results, and at times yielded not so great results. We had a lot of disparity across how we approach the business across states. Ed was trying to gain alignment to sort of herd the cats and get the best practices in a standardized product. And Ed also understood that IT systems were going to be a bigger part of how we did business going forward, and that more standardization around our product design would make it a lot easier to go to market and get us to market faster. So our strategy was, pricing segmentation. The faster you can get to market with the newest thing, the more likely you are going to be successful. So Ed led what we called at that time Product Alignment 1.0. You can see in his 1994 key objectives that someone shared, product alignment was number one on the list. We are now rolling out as a company Product Alignment 8.8, Ed. So what you started as 1.0 has led to a lot of success for Progressive over the years because we're still using that basic format. Ed also charged me with a rather unenviable task back in the day, and that was to standardize violation points. So in auto insurance, you have speeds, you have major incidents, you have accidents, not at fault accidents, and all these codes come from all these different jurisdictions around the country, and you have to decipher that into something that you can then translate into points, which then translates into rates. And I got to do that with a colleague of ours, Dr. James Jang, Ed, who you would be happy to know is retiring at the end of the year. But I'm also happy to say that the structure we put in place there about 25 years ago still exists today. So Ed's influence remains with the company well after he went on and had a great career elsewhere, frankly. All right. Yes, Ed, I was a swimmer at UCLA. That is my connection. There is me, my freshman year, and our team picture outside Royce Hall, for those of you who are familiar with the UCLA campus. I lived in LA for a number of years after my undergrad, and I'm confident, to my recollection at least, that I voted for Prop 103. And given the chair I sit in right now, that's kind of surprising to hear. But as a young person fresh out of college who was, not making a ton of money, and who heard the proposal to, get a check back from the insurance they had paid and have rates rolled back prospectively, I said, I'm in. Had no idea what that meant for the auto insurance marketplace over the longer term. Yes, that is me on my Yamaha Riva 150. I love that machine. And yes, back then, short shorts were all the fashion, just in case you were wondering. I did move on to Progressive, which Ed noted is in Northeast Ohio on the banks of the Cuyahoga River, Cleveland, Ohio. And more specifically, we are located in the village of Mayfield, which is a suburb of Cleveland. And as Ed said, I joined in 1990, actually as an intern during my business school stint, and have been here full-time ever since. It's been a great career. I've done a lot of different things, but I think I learned most about insurance when I was an intern. And in fact, I learned it not from work, but from actually having an accident. I was coming home from work, actually, and I was driving down a two-lane road, 2 lanes each way, and a car made a left turn in front of me. I slammed on my brakes, tried to stop, was unable to stop in time, and hit the back bumper of the car. We both turned into a parking lot of a shopping center next to the road, obviously. And thankfully, a woman in a car behind me also pulled off into that parking lot. So I get out of the car, and the woman whose car I hit is in my face yelling at me, "You must have been going 60 miles an hour, it's all your fault." And okay. And I also was approached by the woman who had been driving behind me, and she said, "That was not your fault. If there's any question at all, here is my phone number." And while this was going on, the woman whose car I had hit, she had sent her child into the store there, I presume, to call the police. This was pre-cell phones. And when he came out, I said, "Hey, did you call the police?" And he said, "No." I said, "Okay, well, I'm going to go in and call the police. It's clearly a dispute here." By the time I got back out, there was an ambulance there, and there were 5 occupants in the car I had. One of the occupants was laying on a stretcher. Another had on a neck brace and was sitting on the curb. And I started to begin to understand what was happening here. Policeman showed up, and of course, driver of the other car immediately in his face. He was going 60 miles an hour. I can't believe it. Totally his fault. And I simply said, "Officer, here's my version, and here's the number of someone who is a third party who might have witnessed the accident." He gets in his car, appears to be on the phone or something, gets back out of the car, proceeds to hand the other driver a ticket, showing that she was indeed at fault for the accident. The minute the policeman hands her the ticket, the gentleman on the stretcher gets up off the stretcher. The person on the curb with the neck brace takes off the neck brace, hands it to the ambulance driver. They all get in the car and drive away. Okay. So, I got a call from the adjuster from a company I won't name, a competitor of ours, headquartered in the suburbs of Chicago, in case you're wondering. But the adjuster says, hey, we've looked at your car and we're accepting fault. And we think the damages are, I forget the exact number, let's say $1,000. And we think you're 20% at fault. So we're going to send you a check for $800. I, being new to the insurance space, didn't understand this 20% at fault thing. However, I was an intern at the insurance company, Progressive, right? And I actually sat down the hall from a guy who was a claims attorney for the division I worked in. Went down to talk to Andy and said, hey, this is what this adjuster's telling me. Can you help me understand what this is about? And he told me, John, call that adjuster back and tell him your neck hurts. Okay, Andy, I'll do that. So I called the adjuster back and I said, I just talked to my friend here, the claims attorney, and see, he told me to tell you that my neck hurts. The adjuster said, I understand completely. I will be sending you a check for $1,000. But the learnings continued because I was a poor student and had very little money. And this was a beater car. This car actually had been handed down to me. I shouldn't say it was a hand me down from my father. So I was a student, wasn't making any money. This was a 79 Buick Skylark. And when I got a real job, I was planning on getting a nicer car. So I just wanted to get it back to pre-accident, to drivable condition. So I was going to fix it myself. I went to what I called a junkyard then. Well, we don't call it junkyard then. We call it a yard full of like, kind, and quality repair parts, and looked for parts I needed to fix the car. And I found what I understood later to be a front right clip. So this is a bumper, a grill, the whole right fender. And I said, well, how much is that? And the guy said something like $200. And then, I really only need a bumper and some headlamps because I just want this to be legal till I get out of business school and get a real job. And he said, okay, $100. So I learned even more the art of negotiation and reparations of claims. So point being, I learned a ton about an accidents. But why do I tell you this story? I tell you this story because around 10, 12, maybe a little more than that years ago, we started hearing that the Google car was going to eliminate accidents and the auto insurance industry as we know it. But I thought back on that experience over 30 years ago, and I happen to drive that same road to and from work today. I have a son who I handed down a 2017 Jeep Grand Cherokee. So he is now 2 years out of college. I handed him down a car as well. And if Ted were in that car driving down that same street today, he could be in the exact same accident. That car does not have any forward collision warning or automatic braking. And even if it did, that left turn accident is a very difficult one for robots to handle. Regardless, it doesn't have any of that technology. What would be different today if he were in that accident? Well, he'd have a cell phone, so he wouldn't have to go in the store. That's the starting point, right? But would that accident be more expensive or less expensive? My 79 Buick Skylark, I could change the headlamp on that thing for $50, probably less back then. My headlamp on that Jeep Grand Cherokee, it's sophisticated. It has automatic high beam. It might even, I forget if it angle left, right. That thing's worth at least $1,000 to replace. It's way more expensive. There are way more sensors in this car. How about the injuries that potentially were caused from that accident? More or less expensive these days. Medical inflation has outpaced inflation generally for decades. Way more expensive. How about attorney involvement? Higher or lower today than back in 30 years ago, way higher. So clearly the severity of those accidents are higher today. How many similar cars are on the road today, right? We have a 2017 vehicle without any of the new technology in it. There's about 250 million cars on the road in the US today. Some of them have technology. We're going to talk about that in a bit. Most of them don't. You know, I'm willing to guess there's a couple 100 million cars on the road, like the one I gave my son Ted. And they have a useful life, generally speaking, 12, 13, 14 years now. So at least when you think about the world in those simple terms, I think you'd say probably likely that there's going to be accidents and they're going to cost you money for a number of years now. Recently, I had to put this in here. It's not originally in my slides, but so 2 weeks ago, the cover of Business Week magazine, driverless cars are going nowhere. Massive investments over the years, and they said they're going nowhere. Now, I don't believe that, honestly. Technology is definitely playing a role in accidents and accident frequency. We'll talk more about that. But it has definitely not been what was put forth at least a decade ago. But let's take a quick step back and think about the property and casualty insurance business in total in the US. It's about, $750 billion industry. That's a lot, right? Almost 800 billion actually here. And around a third of that is personal auto insurance. Obviously, I stole this slide. This is a Progressive slide. You all don't necessarily care about our market share, but the point is, auto insurance is a massive industry. What makes it a massive industry? Well, what makes the auto insurance industry? You have to have cars, right? You have to have drivers. So this is a view since 1989 of the number of drivers and vehicles in the US, top right-hand chart. Those lines are clearly going up, right? I said 250 million vehicles. That's actually a little low. We're over that now. And, those lines don't appear to be dropping. Now, there's some debate around Uber and Lyft and urbanization, et cetera. Would those drop the number of vehicles per household? That's a rational view. It has not happened. And obviously with the pandemic, it took quite the other turn. Accident frequency, however, it's been going down for quite some time. And this is sort of a 30-year view. If you go back even 50 years, accident frequency has been going down. A lot of that's technology, some of that's societal attitudes towards safety, a lot of it's design of roadways, intersections, et cetera. But accidents frequency has clearly been going down. It doesn't go down, consistently, but it's definitely going down. Accident severity, as my example, I hope, highlighted, it continues to go up. And it has been going up at a rate far in excess of the rate of decline of auto accidents. So net, all this stuff combined means that the private passenger auto marketplace continues to grow. Question, obviously, is looking forward, will it continue to grow? And if so, at what rate? It's a question we've been asking ourselves, not surprisingly, as a big auto insurance company for quite some time. Our current view is the top chart here. And this is a model. We all know how valuable models are. But if you make a bunch of different assumptions around the adoption of technology and how quickly, cars are retired, you can come to a pretty wide range of how big will the auto insurance industry be 35 years from today. You can see our base case says it's going to continue to grow. And this is nominal dollars, top top chart nominal dollars. Upside, over $1 trillion industry, right? That's massive. Downside shows some decline a little bit in the near term with some growth out in the outer years. It's really hard to know, but we're confident that there's going to be a robust personal auto industry for quite some time. And just for other perspective, I'm sharing with you our first effort at trying to gauge how big the personal auto marketplace would be, which we started that effort in around 2010. It's when the Google cars started coming out. A lot of articles were saying auto insurance was going away. We put together a model, less sophisticated than today's model, admittedly, but we put together a model and we created what we called the range of uncertainty around how big the industry could be. And when we look back at that model, and this time we did it in real dollars just for clarity on what the chart is showing, we looked back on that and looked at the actual result in 2021, and lo and behold, actually it was 2020, I think, the actual result was above even our most optimistic outlook for the personal auto insurance industry. So certainly a lot of uncertainty, but certainly original hype, I'll call it, around technology and vehicles was a bit overplayed. Take a little step back further and say, well, what is this technology and what are our projections around when it starts to roll out? When might it be, part of the fleet in any substantial matter? And this is, again, maybe dated by a year or so, but the industry talks about 5 levels of automation. 5 being, as we had a futurist come talk to us in 2010, and they told us 5 years from then, you will pick up your phone and say, Siri, bring the car around. And, the car will take you wherever you want to go. That's level 5 automation. We're sort of at 2-ish, some 3-ish. But this stuff takes a long time to move into the fleet. A lot of technology starts as an option on vehicles, obviously on high-end vehicles because they cost a lot, or that the technology costs a lot. It takes a long time for new technology to become standard on a vehicle, to get to a point where it's produced at a volume where the cost gets down to something that is sellable in a more standard vehicle, if you will. And what we're showing here is the penetration of the fleet for a couple previous technologies that have rolled out. Forward collision avoidance is in a lot of new cars now, and it's standard on a lot of new cars. And my new car, it's a 2022 BMW. It has, automatic braking as well as forward collision avoidance. So it brakes the car, and I'm guessing a lot of you have cars that do the same. But it takes a long time from introduction to get to 50% of the fleet. You can think of like 20 years to get to half the fleet, and more like 30 years to get to most of the fleet. The other challenge with a lot of this technology is that consumers turn it off, myself included. So my 2022 BMW had lane departure technology in it that if I approached the lines, it would pull me back. And I don't like that technology. And apparently a lot of other people don't as well, because BMW has the switch to turn that technology off is in the middle of the dashboard with a big red circle around it. So I first thought, hey, this is going to be hard to disable this stuff that is bugging me. But lo and behold, it bugs enough people that they made it really easy to turn off. And there's studies around cars that go back into dealerships for service and what percent of those have the technology disabled. It's a lot of them. But, it does help claims frequency. A lot of this technology is absolutely continuing to lower claims frequency. There's a lot of different studies on this. It is really hard to figure it all out because you don't know exactly when it's turned off. But HILDI, so the Highway Loss Data Institute, of which we are a member, studies this extensively. Obviously, we study it extensively internally as well. And our goal is to price to it before our competition does. So if we can figure out the car that is going to be safer, that's going to have fewer accidents, and again, overall cost us less. So it's obviously that insurance is not only the frequency of you hit stuff, but how much it costs when you do. We can figure that out faster than the competition. We're going to price to that, and we're going to try and get all those customers before our competitors do. If, however, vehicles are touted as being, technology full and consequently accident free, but that doesn't tend to be the actual case. And when they get in an accident, they're super expensive to fix. We're going to have a higher price for those. And that's what we want to do. And we're going to hope our competitors have a lower price because they're going to lose money. But HILDI has followed a number of these technologies since introduction, and they definitely decrease accident frequency. So this is by coverage for those of you less familiar with auto insurance: collision, property damage, liability. So I'm hitting somebody else's car, bodily injury, MedPay, PIP, personal injury protection. And you can see, the range. But we just talked about front collision warning. FCW is the first one on the left. 10%-ish probably reduction in accident frequency. Front AEB, automatic emergency braking. So that means I'm approaching something and it brakes for me. I use, when I'm doing cruise control in my car, I have AEB enabled, and it also automatically backs me up so I'm not crowding cars. It's really slick technology. And this, again, you eyeball that and you say, probably 10%. Curb adaptive headlights, etc. I won't go through all of them. Technology is absolutely helping to reduce auto accidents, which is outstanding. What does it do to severity? And this is evolving too, because manufacturers are starting to figure out how to have the technology on the vehicle, but also not have it in a location that when there is an accident, there's as much damage to it. So it's really expensive. The technology is really expensive. So this is evolving, and this gets to a vehicle level. It's a little harder to parse out if you don't go to a vehicle level. Clearly in aggregate, severity's up, right? How much? Tougher to say. Less than 10%, though, that's pretty clear, right? Point is, this technology is definitely impacting our industry. It is reducing frequency. It is increasing severity. And get back to the longer term trends, has been at least increasing average loss costs, which grow the size of the auto insurance industry. So again, we think there's going to be a very robust auto insurance industry for quite some time. Obviously, we have, we might be a little biased based on the primary business we're in, but I think we also study it with pretty great diligence. And there's a range for sure, but we're pretty confident there's going to be a big industry to play in for quite some time. I want to talk a little bit around nearer term auto trends. So we just did the, 35 view forward looking. More recently, the trends in auto insurance have been super interesting. And somewhat difficult to manage in. So COVID, you all know, we all sat at home for a while, right? So this chart shows vehicle miles traveled on the top, and then on the bottom, it shows the percentage change versus what we think of as the pre-COVID period, which was 27 through 2019, and how far off driving levels are today relative to pre-COVID. The top, you can see obviously driving dropped through the floor when we all went home in March of 2020, but it's come back. But it has not come back to pre-COVID. Still running sort of 10-ish% below pre-COVID. Why? Well, most of us are sitting at our homes. I'm actually in our office, but a lot of people are still working from home. And so commute is down, right? And commute is when a lot of accidents happen because congestion is highest during commute periods. Those accidents are also less severe because people aren't going as fast in commute because they're in traffic. But there's a lot more accidents. And those accidents will frequently involve not only car damage, but an injury of some sort. So figuring out where this goes over the long term is really key if you're sitting in our chair. And we've been studying it pretty hard. It has not moved a ton lately. And in fact, the frequency of accidents continues to be down a little bit more than vehicle miles traveled. We study that a lot, time of day, type of driving condition, if you're driving to work, if you are traveling for pleasure. We think we have decent understanding of it, but it's really hard to project. And when we're creating insurance rates, we're obviously creating rates for the future. So our objective is to predict them accurately. And right now it's pretty hard, frankly. The other thing, my guess is you all are very familiar with, is that used car prices are through the roof. My, real world example is my second oldest. We bought a Subaru Impreza for a while. He was in college. So we bought that car as a 2018, I believe, and I think we paid about $18,000 for it. My son graduated, got a job, and he was looking to say, hey, do I want to keep the Impreza? Do I want to get something else? And he went and figured out what it was worth. Now it's like 25,000 miles on it, and it's worth $22,000. So it's worth $4,000 more than we paid for it 3 years ago when it was new. It's a crazy world for used car pricing right now. This is the Manheim Index. It went up something like 50% in the course of a year. It's coming back down some, but is obviously still way above where it was. So this drives the severity of claims a lot. So we total a lot of vehicles, but even if we don't total them, if the value of the car is higher, we're going to repair a car with much greater severe damage than we did previously. So this has driven our costs up a lot faster than we expected. We did expect some of this because we understood, production limitations during COVID. We had projected some increase in the value of cars, but nothing to this degree, frankly. So where does this go in the future? That again is really hard to know. Right? Where would you create the trend line from the chart you're looking at? It's pretty difficult to know. So far, we've been doing okay at it, I would say, but the industry is struggling mightily in figuring out where the right price level is for auto insurance going forward right now. Since most of you are in California, I can't help but share some perspectives on California. And because of the regulatory environment, so Progressive has two programs in California for personal auto. One we sell direct to consumers, online, over the phone, etc. One we sell through our independent agents. And because of regulations within the state, actually the business we sell through agents actually reports up through me. It's the only operating business that reports to me as the CFO. So I'm quite aware of what's going on in the California marketplace. And right now, rates are inadequate. I know they're inadequate for us. I'm confident in saying they're inadequate for a lot of other companies. I obviously don't see their data, but I'm confident in saying that. And my guess is some of you on this call I know that far better than I. The department is not allowed for a rate increase in more than 2 years. I think it's more than 2.5 years now. And we just described the trends. And in California, we also have a interesting system where the body shops get to decide what their labor rates are through a survey system. It is not sustainable in its current state. That I'm confident in saying. So we are doing our best to advocate for change. But more holistically, I look at the system and say, this is the largest auto insurance market in the United States. It's California. They're forward looking on everything, right? Technology, Silicon Valley. And you look at the auto insurance space and you say, is it? Prop 103 mandates what you can rate on and the relative weighting. California snapshot for us is what we call our usage-based pricing mechanism. This, I would argue, is the fairest way to price auto insurance possible. So I tell people, I was born a guy, right? I mean, yes, I could change that, but I pay more insurance than my counterpart who's a female. I have no control over that. How I drive, I can control. And if that can change my insurance price, that seems about as fair as it can get from my perspective. Not allowed in California, and the only state in the United States where it is not allowed. Doesn't seem to make sense to me. I throw that out just as an opinion for you. Those are my thoughts on the longer term outlook for auto insurance. Some are nearer term trends that we're working through, and my own personal opinion on the current state of the auto insurance marketplace in California.
Great.
Those are my
John, thank
prepared
you.
comments, and I'm happy to take questions if you have.
Yeah, I think we've got some questions. I guess the first one would be about electric vehicles. You read that they have some different performance characteristics and that sort of stuff. Are those things that you guys have seen, you're alarmed about, you feel you understand them, whatever, because there's starting to be a fair number of them out there.
Yes, there absolutely are. And yes, we are very interested in, we study all vehicles, types, and characteristics. Electric vehicles are a bit challenging at this point, and I think once they become more prevalent, they'll be less challenging. But repairs on a lot of the electric vehicles are extremely expensive, and managing the battery is difficult. And most body shops, increasingly, there are body shops that can handle these kind of complex vehicles, frankly. And all the tests, I mean, it's not just electrical vehicles, but tests to ensure that technology is brought back to pre-accident condition. It's expensive equipment. Not all body shops have it. So yeah, we're trying to understand it. And like I said at the outset, our goal is to always understand the stuff before our competitors do, so that we can put it into our pricing before our competitors do. So
Yeah.
lot of media around this as well, and there are some who believe that their vehicles deserve far lower prices than the market provides them. And I would offer the market is only pricing to their experience. So if we can figure out how to get the experience better, the prices can come down.
Right.
But we're in the business of pricing to cost, and we go out of our way to try and understand that cost better than a competition. And so far, we have found electric vehicles to be more expensive to insure, is the bottom line. Will that be the case over the longer term? I suspect not, but that remains to be seen.
John, remarks in your remarks have probably appropriately centered on the cost of vehicles and that sort of thing. One of the alarming statistics that, if one looks at fatality rates, over an extended period of time, it's been an incredible public health success to see fatality rates drop from the 50s maybe, or it's been a long period of time that there's been really significant improvement in highway fatality rates. They've really turned the other direction. And sort of thoughts from you guys. I mean, obviously you have a ringside seat for all of this. I mean, what do
Yeah,
you think has caused what is really an alarming turn of events?
that is a great question, Ed. And I actually think the latest data point was back down. I don't have that in front of me. But yes, you're right. It had been going down for a long time, and more recently it's been going up. But I think the last data point down, we can't explain that fully, frankly. We analyze, especially with the data we have from our snapshot devices. So we have a lot of real-time data around when accidents happen. I mean, we can understand what's going on in the car. And speeding for sure at the start of the pandemic spiked. And it has not come back down. So people got used to driving a lot faster, most likely because there's less, there were less cars on the road, but they've not slowed down yet again. Right. And enforcement, we know, meaning people getting stopped for speeding, is down a lot as well. At the outset of the pandemic, that was very understandable. You didn't want to go up to a car because you didn't know if the person driving the car might be carrying COVID. So that is understandable, but enforcement has not come back to pre-COVID as well. So those violation points that I talked about that, I worked on early on in my career, those are down. So there's fewer tickets being issued. And so I suspect that speeding will continue until there's more enforcement. So I can't tell you we understand that completely. But certainly I'm confident saying that the increase in speeding that's been going on is part of it.
Gotcha. Well, this has been a wonderful talk about auto insurance. I got a question from someone about homeowners.
Okay.
Which essentially, basically, let me go and make sure I can read it for you. Let me go back far enough. Apparently, Progressive's changed its views. I haven't kept track on underwriting homeowners. I know that there was a stop, I thought, in Florida, which given the events of the last couple of weeks, seems like it was a fairly good decision. But without being proprietary at all, could you talk just a tiny bit about homeowners?
Sure. Progressive's hallmark over the years has been to price everything better than the competition, but we've also been a company who is open to all. So we say there's no such thing as a bad risk, just a bad price. And I'm not so sure that's the case in homeowners. So, we bought a company that originated in Florida, and their second state they entered was Louisiana. Their third was Texas. So they inordinately weighted to coastal risk. And over time, we're now maybe in all 50 states, maybe not quite yet, but effectively across the country. So we've lessened our concentration on the coast there, but it's still very high. And, we're confident now in saying we need a different footprint as a company in terms of our property exposure to have greater probability of consistent profitability year in and year out. So when you look over the long term, there are parts of the country that have far less volatility. Think Northeast, think Northwest. Our first expansion beyond the coastal states with property were the central states, which some people call Hale Alley, which is not a great place for homeowners either. So I think we've taken steps over the years to diversify our risk. We think we need to take further steps to diversify it in a more constructive manner. So that's what we're doing. So we're gonna shrink our Florida book. we're going to stay kind of flat in other coastal areas. We're going to grow in areas that have far less catastrophic risk.
That's terrific. Hey, one final question, and then we'll let you go. But a question came in. Apparently, in your ads, you talk about what you're going to do with the savings from whatever. If you buy your progressive policy, and I received the question, what is a weighted blanket? Which apparently comes out as apparently one of the leading things people would spend their progressive savings on.
A weighted blanket?
Yes. I mean, that features prominently in your ads.
Well, I used to oversee the ads, Ed. I no longer do. What I do know in Cleveland, however, we're getting close to winter. And on my list to do is get a new electric blanket because ours stopped working.
So
I don't know what a weighted blanket is, but I do know what an electric blanket is.
I see. Well, maybe somebody out on the chat can.
They do. Some
the
people
person that
find
asked the
comfort
question,
under a
obviously not.
heavier
But
blanket.
yeah.
Dave Russell explains to us.
Indeed.
I'm going to find more comfort under my electric blanket this winter because it gets a little cold here in Cleveland.
No, I am certain that's true if memory serves. Well, John, thank you so much. Please pass my regards on to everyone there. And
Very welcome.
I don't get back often enough, but when I do, I'll be sure to stop by.
Fantastic. Enjoyed it. Thank you all.
And know you'll get a warm welcome out here in California when you make your next visit.
All right. Thanks again.
All the best. Thank
Bye-bye.
you so much. Indeed. Okay, well, that brings us to the end of that topic. And I think it's probably now time to take one of our short breaks. And at the conclusion of that break, Caron will come back and introduce the next set of speakers. We're going to go from a change in format of instead of just having an individual speaker, good that both of them were, we're going to go with some panels, which I think you guys may find just as exciting. So why don't we take just a bit of time off, and when we come back, you'll be pleased to see Caron on the screen, and we'll take it from there. Thank you.